Hey, what's going on, everybody? It's Wednesday, January 5th. Wow. What a day, what a day, what a day. Big drop in the NASDAQ. I think it was the biggest drop since last March. All right, I got a lot to say about this. This is going to be a longish video. I hope you stick with me because a lot of information to unpack here. A lot of information. First of all, I mean, how many times do we have to see this? This is the monetarist hysteria, the zombies going crazy again. Comments from the Fed's December minutes, the meeting that they had, talking about now reducing the size of its balance sheet, maybe going ahead with rate hikes a little bit earlier than planned. I'm going to go through this whole thing, but first I want to start off by saying this is just another one of these panicky reactions. It is, just the type of mentality that is pervasive, this kind of monetarism, this monetarist mentality, tunnel vision about the Fed and monetary policy. And personally, I love this. I mean, I was doing some buying of tech stocks today on the pullback, and I'll get into that. But let's talk about this Fed balance sheet situation. And I did a video on the balance sheet before. The balance sheet of the Fed is only relevant in the sense of how it affects the composition of dollar assets in the economy. So basically you're talking about, when the Fed expands its balance sheet, you have more reserve balances and less treasury securities. Okay, when the Fed contracts its balance sheet, you have more treasury securities and less reserves. Treasury securities and reserves are interchangeable. Those are dollars just in two different forms. There is no quantity change in the amount of dollars or dollar equivalents in the economy from anything the Fed does on its balance sheet, whether it goes up or down. The only real increase we could ever have is when the fiscal pump comes in, either putting it in through deficit spending or taking it out through taxation and shrinking the government's balance. Monetary policy is, at least in that regard, it is irrelevant to the economy. Now, rate hikes or rate adjustments are price adjustments. And their impact is like any price adjustment. It could either raise the general price level when rates are lifted up because the cost of credit is reflected in the cost of all goods and services, or it can reduce the general price level when rates are cut because, financing becomes cheaper and that is reflected in the cost of all goods and services. There's one other aspect to rate adjustments. They can either be fiscal expansions, okay? So when the Fed raises rates, necessarily the government ends up paying more interest because the rates are up, and that is a net fiscal injection, all else equal. Or when the Fed cuts interest rates, that is fiscal drag. It is removing income via that interest channel. As far as the balance sheet is concerned, again, it is completely irrelevant. It's only relevant to the extent of how it affects the composition of dollar assets in the economy. That's it. I mean, either you have more reserves and less treasuries, or less treasuries and more reserves. They're interchangeable, okay? I mean, nothing changes. So when you see a reaction like this, it is a clear, if you know anything, if you understand this, which 99.9% of the people don't. I mean, if you understand this, a reaction like this is irrational because what's happening has no bearing on the aggregate economy. Now, it might have a bearing on certain sectors, all right? But that's true for anything. That's true for inflation, that's true for deflation, that's true for, tax cuts for the rich, that's true for, food stamps and unemployment benefits. I mean, that's always true. It's going to affect, parts of the economy differently than others, because all that stuff is a redistribution of income. I mean, and you know, for the last 40 years or so, most of the distribution has been to the upper echelon of earners. I mean, it really hasn't been to the bottom. The only time it's been to the bottom, you know, was when we had the pandemic and there was massive stimulus and people got checks. People got checks from the government. Here's money, here's money. And that, you know, I've been talking about that. I mean, you saw personal saving go from what, 300, 400, 500 billion to 6 trillion? I mean, that's, you know, that was like, if you look at a chart, it's just like amazing. Now, that's way back down again to 1 trillion because tax collections are expanding faster than the spending, faster than the fiscal flow, right? The swimming pool, the water's coming in, but it's coming in at a slower pace. In the meantime, you got a crack at the bottom of the pool, it's draining out the water, so the level is coming down. Those are the savings. That's the net, the stock of financial savings. That's the water in the pool. It's coming down because you got a leak at the bottom of the pool, which is draining faster than the water coming in. But this stuff about the balance sheet, I mean, that's all you, I mean, this is this kind of crazed monetarism that we've been involved with for 50 years now. You know, this just myopic focus on the Fed and monetary policy and central banks as if they are, you know, the all-powerful controllers of the economy. They're not. I mean, you could go back and look at every period of rate hikes, rate cuts. As long as that fiscal pump is flowing, you know, you have a steadily expanding economy as long as you have the real assets to, you know, to produce, to you know, raise the level of output. I mean, if you don't have the labor, if you don't have the natural resources, if you don't have the energy, if you don't have, you know, healthy people, I mean, that's, look, the Fed is going to raise interest rates now and squash inflation when we're getting, what, 1 million new cases a day of COVID, people in hospitals, I mean, the pandemic going rampant, but this is their belief. It's completely out of paradigm with reality. I mean, they're completely, you know, I mean, they're crazy. But you have to understand it for what it is. The balance sheet is irrelevant other than in the sense of what I just described. I mean, you want more reserves or you want more treasuries. You know, when the Fed does QE, that's the same exact thing as the government never having sold those bonds in the first place. Okay? And when the Fed does QT, quantitative tightening, taper, whatever you want to call it, that's the same thing as the government having added more reserves and less treasuries. The two things are interchangeable. I mean, it doesn't change the quantity, the level, the quantity of dollar financial assets in the economy, at least with respect to what the Fed is doing. Now, again, Congress can change that at any time. They could decide to, you know, send out 6 trillion in checks. Yeah, that changes it. Or they could decide to tax everybody like crazy and reduce it by 5 trillion, which is exactly what's happening now. That changes everything. But that's not what people are looking at right now. But that's what they should be looking at. But actually, I'm glad they're not looking at it because I am looking at it and that gives me an advantage. So, long story short, this is just bullshit, excuse me. I love to see this reaction because it is driven by total, absolute ignorance, okay? And it may continue for a while. By the way, yesterday I think I said, look, bullish sentiment was a little high. As you know, I've been on the defensive. I've been sending that out to my people, my subscribers. We're all positioned defensively. But when I saw this today, I mean, you know, it's like I had to hold myself back from jumping in there with both feet. I still wanted to see the fiscal flows, which, by the way, I'm just looking at that today. You know, we're going to be running around a 550 billion monthly rate, which is fine, okay? I looked at the first Social Security payment of this year. It was up 12% versus the first Social Security payment of 2021. Now, I think that's a little high, But let's say we average out at around 6 or 8%. We're looking at what, an 80 billion increase in flow from Social Security. I think it'll be up about 8% because with the raise in Social Security and with new enrollees, like every year you get more because you get the baby boomer generation who's turning, age where they could receive Social Security. So the recipient rolls go up. Plus you have an increase in, because the cost of living increase, we're going to get 80 billion out of this. All right, so it's not quite going to offset the child tax credit payment, but it's close. It's close. And then if the Fed raises interest rates, you're going to get more interest income flow into the economy. That's a fiscal expansion. Everybody sees this the wrong way. And it's great. I mean, if you have knowledge, if you have information, if you have understanding, if you know really what's going on, I mean, that's an advantage. You just have to understand that you got a crazy herd of people reacting in this panicky fashion, and sometimes you might have to step out of the way, or sometimes you have to be a little patient. Usually I don't step out of the way. If I see the market pulling back, and if I know it's being driven by crazy irrational behavior, I'll go in there. Yeah, it might go against me for a while, but you go in little by little, you build a position, you don't overexpose, you're patient, and it all comes out to your advantage in the end. Go against ignorance. You always have to do that. So that's it. I hope you understand. This is, I love stuff like this. I love stuff like this. Who doesn't? Go against stupid, irrational behavior. You don't have to know very much. All you have to know is when you see stupid, irrational behavior, you go against it. And, over time, you're going to come out a big winner. Anyway, that's it for the update today. I hope everybody enjoyed it. And don't forget, go to my website, pitbulleconomics.com. If you're interested in an individual subscription to MMT Trader, send me an email at mnorman@pitbulleconomics.com. See you tomorrow. Bye.